good morning to most people. Uh, and It's a real pleasure to present at this conference. So let me begin, but let me begin by first already violating one of the ideas that Pierre mentioned. Uh, my presentation is going to talk about inequality and finance, and inclusion becomes a very core part of it. So you'll see some of that, and of course I'll get to the regulatory side uh, after that. So let me start sharing my screen. I have a few slides to share with you. Um, uh, and Let me see. I just had it up here. Yeah. Uh, okay. So Pierre, can you see my screen? Yeah, okay.
Yes, we can see.
Thank you. Thank you. Okay, so here's just starting really from the big picture. This chart simply tells you, when you look at it from a global perspective, wealth and income inequality have really risen since after the global financial crisis. And just to give you one shocking number, Oxfam estimates that in 2018, for example, 26 people's wealth was the same as 3.8 billion people. So that's quite shocking. So we have to think about inequality in any type of policy. Otherwise, it's simply unsustainable for many reasons, including political and social. Then when you look at the trends in inequality and the levels within countries, on the left-hand side, you see what are the trends, what proportion of countries in advanced economies versus emerging market and developing countries, income inequality as measured by the Gini coefficient is rising or decreasing. So what is clear on the left-hand side is that the trends are much worse in advanced economies. 53% of countries you see inequality rising. In emerging markets, it's much less. It's like 23%. And actually, impressively, to 52%, it's falling. But when you look at the levels, it's really interesting to see that advanced economies have lower inequality as compared to the emerging markets in developing countries. So in terms of trends, advanced economies are worse. In terms of level, the rest of the world is worse. So this chart looks at inequality and its relationship with the financial sector. It's based on a paper I wrote with my co-authors earlier this year. And this basically shows you that in the sample of countries that we looked at, which were about 120, 130 countries for which we have data since the early 90s, we group them in terms of where they have reached in financial inclusion. Here, it's a very simple measure of ATMs per 100,000 adults. And then we explored whether countries which had higher financial inclusion, did they have lower inequality? And what we found on this panel cross-country study is that if you focus just on the low depth chart, which is the extreme left, that if you have greater financial inclusion as a country, you can actually reduce inequality by almost 10 percentage points in terms of the Gini coefficient. Whereas if you don't have much financial um, inclusion, then your returns are much lower. But we did this for countries where financial sector was developed or not developed. And we found that the same relationship held independent of the depth of the financial sector. At any level of financial development, this finding is very robust that greater the financial inclusion, lower the inequality. We also looked at the relationship between financial inclusion of women and men. And in this chart, we looked at two aspects of inclusion, uh, account holding and credit cards, which is a proxy for uh, uh, credit. And the bars basically show you the gender gaps. And in this chart, uh, and the Gini coefficients also, as you can see, are the little triangles. So the key point here is that uh, when gender gaps are higher, uh, there is higher inequality as measured by the Gini. And this holds for both account holding as well as uh, a measure of credit. Now, it is true that irrespective of whether it's men or women, as you know, if financial inclusion increases for both men and women, inequality falls. However, the returns are much higher when you close the gender gaps. And then when you look at financial inclusion itself, what you find is that um, traditionally measured simply as a share of account at a financial institution. So on the x-axis is the share of females, on the y-axis it's the share of males. And then there is the 45-degree line. So there are two key messages in this chart. First, that across the world, what you see is that the level of financial inclusion varies quite widely because you see these dots, which are represent countries. They are closer to the uh, if you see on the left bottom side, they range from very low levels of financial inclusion to very high levels. And the second message is, of course, uh, the gender gaps are quite high because you see most of the dots above the 45-degree line. But there are some green dots where financial inclusion is higher for women. And here's the most interesting chart. If you compare uh, financial inclusion, not measured in a traditional sense, banking, etc., but if you include um, financial inclusion as measured by digital services, and by digital services, we also include simply mobile phone where you do transactions. Um, and when you do that, what you find is countries get cluttered at the top right, meaning more and more countries have increased financial inclusion through digital services. And the inequality between men and women, you definitely see. But still, there's a huge promise of fintech for financial inclusion. So if you look at traditional inclusion, on average, 60% of adult population have access to traditional financial inclusion. But if you look at digital services, almost 80% have access. So then when it comes to policies, uh, you know, there are many lessons here. So of course, there's a promise uh, of fintech for increasing financial inclusion because that helps reduce inequality, as I just showed you. But we want to be very careful that we don't leave the low-income households, the small firms, women behind. Uh, And we also promote digital services. And here are some policies that we have been recommending. We interviewed. This is in another paper. We over the course of 2 years, we did econometric studies, but also interviewed stakeholders. Fintech firms complain a lot about regulatory uncertainty. So that's something that the regulators and central bankers need to address. They really need to catch up with what's going on fintech. Another issue that has come up, both empirical and interviews, is it's surprising how little financial and digital literacy exists in all parts of the world, including very advanced economies like the US. Another aspect is that they complained about there's a global shortage of coders, the guys who actually help build great platforms. There's a need to also invest in these areas, both digital and physical infrastructure. There's a need to build trust. This is not just for inclusion, for other reasons as well. Consumer data protection, cybersecurity. Uh, a fifth one, which hasn't got a lot of attention, we really need to eliminate biases that were there in traditional services, which also then translate into when you have digital services, if one is not careful, because the first entry is by a human who entered the data. Then, of course, I talked about reducing gender gaps because that helps reduce inequality. And then cross-border uh, payments and credit is also important. So interoperability, open platforms are important. And finally, we also want to foster sufficient competition in digital services. And we can talk about that later, which is the big techs are a real threat to a lot of small companies. So then when it comes to financial sector policies, uh, especially during COVID, uh, what we are seeing is that and recommending is that the authorities support economy and the provision of credit, liquidity during this period. But of course, they also have to make sure that financial stability is ensured. Otherwise, it's really going to hurt these countries during the recovery phase. There are some international framework exists that have been guidelines that have been issued um, also by the FSB, and it's really the FSB has like 5 principles, and the international community has agreed to act consistently with these standards and not roll back reforms. Uh, and this is my second last chart. The During this period, uh, what we are recommending is that there is sufficient flexibility in the regulatory framework and the supervisory framework, and countries should use that. They should also help facilitate the support measures that are being provided by the government. Very important to maintain transparency because credibility during this period is important. The supervisors, they have a lot on their plate and they really need to become flexible and reprioritize their work during this period. And then, of course, with an eye to smoothing the functioning of the financial markets and services. So just focusing on the second one, the support measures, here, it is important to encourage and uh, facilitate the if a prudent attitude towards loans. If restructuring is needed, then the banks should be monitoring very closely, and it would be in their interest if loans need to be restructured. Of course, uh, in general, even if there is a payment moratoria, borrowers who are non-performing before the pandemic should not benefit unduly from the government supported measures. And then the borrowers who've not been meaningfully affected, they should continue to pay their debt. And it's also important to not disincentivize uh, the resumption of loan payments at the end of the moratorium. Uh, And if you're thinking of relaxing large exposures and concentration limits, you have to really watch for that. And finally, you have to have an exit strategy. You know, as I mentioned, so that the borrowers will continue to pay. But of course, there are policy trade-offs because you're facing the trade-off between supporting borrowers that are facing shocks and also weakening financial stability. And there are a lot of policies that are of consideration, and I can talk about that later. And finally, the key point I want to make, and this is from another paper, is this concern that came about, especially because of the global financial crisis, where a lot of loans, as you are well aware, subprime loans, were extended to small, low-income households. And because they were not well regulated, ultimately the crisis in the US spread everywhere. What we found based on financial sector assessment programs that we've done is that you can have both financial inclusion uh, and ensure financial stability. The two can go hand in hand. The major requirement is that uh, regulation and supervision should be of high quality. So in this chart, uh, when we look at bank stability measured by this z-score, um, what we find is that you can extend to more and more customers loans, and financial stability can be maintained if you have high Basel core principles, the green dotted line, rather than if you have poor regulation and supervision, which is the red dotted line. So thank you very much, and I'll hand it back to Pierre.